The following content is provided under a Creative Commons license. Your support will help MIT OpenCourseware continue to offer high-quality educational resources for free. To make a donation or view additional materials from hundreds of MIT courses, visit MIT OpenCourseware at ocw.mit.edu.
I think at the beginning of the semester, we had kind of sketched out the broad plan. And the broad plan was to move kind of progressively from what are fundamentally individual decision-making problems to thinking about more problems of the market. And we're going to turn to insurance, which is obviously something to do with markets. So here's by way of background. Probably remember a few years ago, the world economy was in crisis. It may still be in one, but now we're told it's not. So this is a quote from the president of the World Bank, who is trying to make the case that the crisis in 2008-9 was going to be a particular crisis for the world's poor. And that's not implausible. You might imagine that if you are that much closer to survival, or you have fewer resources, then anything that goes wrong is likely to hurt you more. So that's not an implausible idea. I spent a couple of days with a New York Times reporter, the New York Times bureau chief in India, in the pursuit of this story. So I was going for something else, and she came along with me. And she was looking for people who this was in a part of rural India, in a very poor part of rural India, and her whole idea was that she's going to go there, and like Zelig, she was wondering how these people in the villages who go to the city to work as maybe laborers, how they would be affected by this global crisis. So she wanted to. This is the New York Times, so she wanted to link up what's happening in poor parts of rural India with what's happening in New York. So that made perfect sense. And the problem was that nobody seemed to know there was a crisis. In fact, so she would go and ask people. Have you heard about there's a crisis in the world? Is that affecting your job prospects? And one striking fact was this was in a part of rural India that's pretty backward. The areas we were mostly conservative Muslim families. A lot of the migrants had come home for a Muslim religious festival. So there were a lot of the migrants were there. We could talk to them. And to the man, literally to the man, they said, no, what crisis? There are jobs for anybody who wants a job. It was like everybody. We went to the train station to look for migrants coming back from having lost their jobs in the cities. In fact, we found tons of migrants who were leaving for the city on the train. So basically, the story never got written. And New York Times never had this story because there was never anything to be found. And it was kind of striking how disjoint these two worldviews were. Now, that doesn't mean, I think it was clear that if you looked at the data, there were people who were losing jobs. I mean, some construction projects had been shut down. There were certainly some jobs being lost. I think the real reason why this didn't show up in people's kind of intellectual map as a very big deal is not because some bad things were not happening, but it's more that they're used to having like jobs being lost and having to find jobs and things like that as a normal part of their life. In other words, the amount of risk that they normally bear is so large relative to any our perception of risk. I'll show you some numbers in a bit. Our perception of risk, that this was seen as normal turnover. Certainly some jobs were being lost, but you find another job. And the basic difference came from, I think, their calibration of what is unreasonable amount of risk. Our colleague Rob Townsend, who is an expert on Thailand, studied the Thai economic crisis of 1998. So this was a big deal in Thailand. I mean, there was like the Thai baht, I think, halved or more than halved. I mean, it just and the whole economy. Several banks came close to failing, had to be bailed out. All kinds of bad things happened. Rob, however, doesn't study the banks. He studies the people who live in poorer parts of northern Thailand, and he has a panel of people for more than, I think, 12 years. But he had a long time. He had been following these people, or 15 years something. He's been following these people for a very long time, families, and looking at the economic outcomes. So every few months, they go back to the same families and measure a bunch of stuff. And the same families are maintained for a very long time. It's a unique data set that he has. Now, one advantage of that data set is you can look at what happens in the crisis year relative to what happens in other years. You're having a data set of the same families for a very long time. Just descriptively, you can just ask, what changed in the crisis year? And I think his number, which I still, he presented this at a conference before he came to MIT, and I had to be the commentator. And the number was, sort of, in a sense, it was almost unbelievable till you think about it. So he found that 2% of the variation in their income was attributable to the crisis. The 2% of the variation of income of these families so if you look at a family, its income varies every year, every 6 months. So you can just look at the total variation in income, and then you can attribute a particular part of that to the crisis. What was extra in a crisis? And I think his calculation was about 2% more for the crisis. So that's just, the reason I make that point is not to say that the poor are very, very well off, but the opposite, that their normal exposure to risk is so high that this additional pieces that come from global crisis is extremely small part of it. And that's sort of, I think, the way to think about it is that there's a ton of risk that any poor person bears all the time, and then there's some stuff that happens which we think are important, like what's happening in New York. And they're important for MIT. MIT, as soon as the crisis hit, the first thing that happened is that we used to get free lunch on Mondays and Tuesdays, and that was shut down. So it was very important. We got some risk from that, but if you think of these people, they're not getting any free lunches in any case. And so the amount of uncertainty that they deal with on a day-to-day basis dwarfs any uncertainty that might come from specific episodes like the Thai banking crisis of 1998. Do you have a question? Somebody had a hand up for a moment. Okay.
Do we have evidence from other places besides Thailand? Because I guess popularly speaking, like a lot of people talk about the lost decades in Latin America and how bad that was, for people's ability to generate livelihoods. So I'm just wondering if we think that this is we really have a lot of evidence that this is really a broad phenomenon, or?
So I think the two parts to what you're saying, both are important. One is, do we have evidence from other countries? Second is, part of the reason why this population is different is that Thailand is a lot less urbanized than Mexico. So you would get many fewer people in many more people in Thailand operate in the traditional underdeveloped economy mode, which is that they are self-employed, they have a farm, something like that. They are not actually, they're not, so I'm sure people, so let me give you a different example, which is maybe even more revealing. This is taking me a little further, but it's interesting. So there's a study by one of our ex-students, what happened in the Indonesian crisis of 1998, which is the same, happened for the same reason, which is, and there the Indonesian rupiah devalued by a factor of 3, which is a huge amount of devaluation. So something really big happened to the Indonesian economy. So turns out that the real incomes of anybody in Indonesia who was mainly a rice farmer went up during this crisis. The reason is that suddenly the currency devalued massively. What happens when the currency devalues and you are in rice? Well, rice is a traded good. Its price goes up relative to non-traded goods. So your haircut prices don't go up, but rice prices go up because rice is traded. So these rice farmers actually were better off in the Indonesian crisis than they were before. He then looks at what happened, how do they react? And one of the things that the thing he's looking at is people attending Quranic reading classes as one of the outcomes. And his basic reason he's interested in them is that he thinks that this is a social support mechanism. Who start attending Quranic reading classes? It's the people who are not rice farmers. It's like government employees, teachers, anybody who has a fixed income, they are the ones who lost. And then the people who were farmers, they actually were better off, and they were actually less likely to attend Quranic classes during the crisis. So in other words, again, a lot of people in a country like Thailand or Indonesia are basically farming dependent, and those people have very different risk patterns from the urban employees. Latin America is very different. Latin is massively richer also than Indonesia, for example. Peru is 3 times richer than Indonesia per capita income, at least in dollar terms. It's also much more urbanized with a labor force that. So I'm sure the lost decade happened. I'm sure that a lot of urban workers in each of these countries gets hurt. The main point I'm trying to make here is that there's also a whole bunch of people in these countries who bear a huge amount of risk even when there is nothing happening in the world economy. And those are people who are farmers, who are, laborers in construction, who are people who work, sometimes get a job in helping out in farms. This kind of people, landless laborers of different kinds. These people have a very different risk pattern from the urban workers, who I think are the direct, who tend to be the people who are directly hurt by big global shocks. So there was not that there were people not hurt. It just there were, for many of the people that, for example, Rob Townsend was studying, there were just all kinds of stuff were happening in their lives. These were all farmers, and lots of them were, all kinds of stuff were happening in their life, many of them very bad, and this was just a small piece of that big story. That's the point that I think is worth emphasizing, is that there's just so much diversity and there's so much risk. So basically, what are the sources of risk? I think the biggest single is just being a farmer. If you're a farmer, you face huge amount of risk. Where do you find, what do you face risk from? What's the main source of risk? Bad harvest. How do you get bad harvest? Rainfall, bugs, locusts. If you're a farmer, you're used to dealing with a huge amount of risk. By our standards of risk, the kind of risk that tenured professors face. Of course, that's maybe that's an extreme example. They have a huge amount of year-to-year variation in income. Even if those who don't have a farm, many of them most of them are casual laborers. They are the poor in most countries. The poor countries are casual laborers. Casual laborers meaning they don't have a contract. They have a daily job. The typical way you get a job is, you in a city, you stand at a street corner, and somebody who wants to needs someone to like move boxes comes and picks up 50 people and takes them somewhere. So it's extraordinarily casual, meaning in a given day you may not get a job, and many of these people are not employed more than 15, 16 days a month. So this is a very, very common fact, and there's lots of uncertainty there. Some months you maybe get unlucky, and you just got there late or something, and then you miss your chance. So the amount of uncertainty that you have if you are a kind of a casual laborer in a developing country is huge, because it's the uncertainty of any given day you have a probability of, let's say, 3 out of 4 of getting a job, and the other days you don't. And so if you look at like daily income is extraordinarily variable for most of these people, and that's just mechanically almost. You just somebody shows up at that street corner, and they ask you to get on the truck and go with him, and he needs 10 people today rather than 15. You don't get a job. So this is just a core level of risk in this life, which is very different from thinking about the kind of risk we think about most of the time in more developed country contexts. There's no social protection. The other side of that is there's no social protection, direct, almost no social protection. But this is a way. One way to think about this is wage volatility. This is how much your wages vary, and this is not day-to-day variation. This is year-to-year variation across a set of countries. Okay? This is real wages. So the poorest country is Myanmar, and it has basically, you can plot a line that's almost and that line has essentially, if you go increase GDP, log GDP by 1, you get you half the risk, something like that. So this is conditional on getting a job. I said the big part of the uncertainty is you just don't get a job. But then the real wages are extremely unstable as well. Part of the reason they're unstable comes from this other fact, which is this. This is food prices. And if you spend 60% of your income on food prices matter a huge amount. And one big piece of risk that people have been facing is just what's happening to food prices. So food prices have gone, as you can see, 2007 they peaked. The food index, dollar food index went up to 200. It came down to 140, then went up, bounced around, and has been climbing since. So that's if you have that's a 60% change in the food price in a year, not a 60. Sorry, it's a change from 140 to 200. So that's a change of 30%. and that change is if you are spend 60% of your income on food, then that's of the order of like losing 20% of your income in a given year. So just food price variation will itself have consequence. Now, wages probably adjust, so that's not probably an overestimate of that. But still, you can see one major source of uncertainty comes from just the fact that food prices go up massively sometimes and come down, both up and down. It's a risk that you see. There's also a trend which is worrying in general, is that food prices seem to be going up systematically over the last some years. What is a bit misleading about that trend is that food prices had fallen for the previous 35 years or something. Food prices had fallen. And so since 1970 to 2005, food prices have basically systematically fallen slightly. And then it's been going up. So this is a bit misleading, this picture. But still, there's lots of uncertainty. The thing I want to emphasize here is not levels, but uncertainty. Food prices are bounce around a lot. If you're poor, that's a very big piece of your income. So just to think about this analytically, there's so risk also matters very much depending on where you are, for example, in your production cycle. So a reason why risk is amplified is when the fact that you get hit by a shock then affects your ability to be productive, which then affects your income, which then affects your ability to be productive, etc. So there is potentially a vicious cycle that can be set off by a shock. When would that happen? Well, we have introduced this idea of an S-shape production function, and there's how many of you read Ibutina's story? What's the story?
It's about a woman who used to own a small business with her husband, in which they had a kind of garment manufacturing company, which they had a bad contract, which caused them to go bankrupt, and that led to a divorce. They tried to restart the company before the divorce. They restarted the company with limited funds and bought a bunch of shorts that they packaged and were going to sell, but that fell through, led to a divorce. The woman has the children living with her parents, and they're just in absolute poverty now.
Yeah. So thing to emphasize there, that story, is that this particular kind of shock she faced was a contract enforcement shock. She had two shocks, both of which were basically, so the first one was someone she had basically sold on credit, defaulted, and therefore didn't pay back the money. And she had taken a loan to finance that, so that kind of put her into trouble. Then she got an order to supply shorts to I think a retail store, and then they defaulted on that. They refused to take the short. So she has very when we met her, she had a huge pile of shorts. She was sitting inside her house, surrounded by a pile of shorts, like a lot of shorts. 12,000 shorts or something. So she lost a whole bunch of money on that as well. So, but then basically, the point is that what is also striking about her story is this, this dynamic. So, what this picture does is so it's like that S-shaped curve, kind of S is maybe an exaggeration. That's the mapping from your wealth today to your wealth tomorrow. So that tells you, given today's wealth, what your tomorrow's wealth would be. So let's take that as given. Now, the main point of drawing it that way is that if you think of what's happening around the point P, look around the point P, think of a path that starts just above P. Where's that path going? Explain.
The second intersection there.
Right. So any path that starts to the right of P, you can see that like the one example that's drawn, the way to analyze this is to think, you start with a particular wealth that generates that wealth tomorrow. That wealth is the same. So tomorrow's wealth then becomes today's wealth. The way you do that is you map that through the 45-degree line, and you look at where that will be, and that sequence is just going up to the point where the second intersection is. Who doesn't understand this picture? I'll explain again, because we'll come back to this picture. Okay. I'll assume that you are comfortable with this picture. Okay. I'm not surprised, but just in case. And then what's key is that if you're on the other side of P, you're going the other way. So if you're close to P and you get hit by a shock, your wealth goes down by a small amount, that's not where it stops. Your wealth goes up by a small amount, you go up a long way. Your wealth goes down by a small amount, you go down a long way. So there's a natural amplification. In this, if the production technology looks like that, then there's a natural amplification of a shock. A small shock turns into a big shock here. That's the point of that picture. So now it's very difficult for her to get out, because basically she's never generating enough surplus to make the investment she needs to get the next period's output to be high enough. So she's always like cutting back and cutting back and cutting back, and that's sort of like, so in other words, not only is there a lot of risk, there's a lot of technologies in the world which amplify that risk. So we already talked about another aspect of it last time. What was that? Another aspect of risk, kind of an amplification of risk. What happened? It's not quite an amplification. We talked about what happens during droughts. Who was here?
During droughts, girls are more likely to be
Allowed to die. You were going to say allowed to die?
Yeah.
Are you looking for that word?
Yeah.
Yeah, I figured it's an awkward word. Yeah, exactly. So, so another aspect of this risk is that you sometimes respond to it in drastic ways. So one of the drastic ways you might respond is by, why are you trying to do that? Because you know that essentially, if you want to, if you have 2 children, you can't feed either of them. Both of them are going to starve and be hurt. The long run health will be hurt. So you kind of switch your money to one of them. That's another way in which you sort of maybe create a long-term problem. Maybe one of those children doesn't die, but she starves and grows up as someone who has a handicap all her life. So you amplify lots of shocks by taking these extreme decisions under these conditions. So first, so this is just saying that when you think that you can't really, so balancing risk is difficult if you don't have a lot of money. It's not surprising, but it's. Moreover, here's an interesting fact. So risk means stress, right? It doesn't just mean that something happens to me. I also worry about it. It would be amazing if you didn't worry about the fact that, tomorrow you might have to starve one of your children. So risk means worry. Now, it turns out that when you worry, your body actually reacts in a particular way. It generates cortisols. And cortisols are a body's kind of defense mechanism to keep it going under situations of stress. So they are actually a natural response of the body to a situation of risk. It's probably, in a sense, a good reaction from the point of view of certain types of survival. But there's a lot of lab experiments where basically what they do is they stress people out. So I think the one that there's a bunch of them with Princeton students, so who are not exactly the world's poorest, but the way these experiments go is they give you an endowment, and then they take away some of that endowment, and somehow people get stressed out when you do that. You make it. Even if, obviously you're a Princeton student, it's not that you're going to run out of food. There's plenty of food in the dining halls, and there is, you're probably going to have your lifetime income is unlikely to be affected by the fact that you lost $5 in this experiment. But people get stressed out when you put them into these situations, and then the experiment is to make them play games, sort of like problem-solving games. And you get a massive reduction in their problem-solving ability. Maybe they're not MIT students, so maybe they're just not as good at it. But still, you see that they do really badly when you put them under stress. So like little bit of stress, some fake stress. Basically, they were going to get $10, and instead they end up with 2 or something. And that kind of stress already makes them take really bad decisions. You might imagine if you had real stress, your child could starve, your mother could die, you could lose your job. You're not going to be taking a lot of good decisions. Yeah.
In the experiment, was the endowment or money related at all to the outcome of the games, or was it just like they were giving money to?
No, these were separate. So the games were the games, but before the games, there was you created some general unpleasantness for them. They thought they would get A, but they get B or something. You can't do. One of the rules of experiments, you can't make people worse off. So these people were not made. They were first given some money, then some of that money was somehow taken away from them. So this was like, but somehow even that got them so stressed out that they started playing games badly. Melissa?
Oh, this is a stupid experiment. If I do well, they're just going to take it away from me again, so I'm not going to make any effort.
How do I know? Because I think they believe the experimenters. I don't think that they thought that. So they were told from the beginning that when you join this experiment, you will lose, there'll be some uncertainty that's going to be created for you. So the experiment was done relatively carefully to avoid the possibility that they think this is just a mad world. I think the most experimenters worry about that, which is you come and tell me that I'm going to do this to you, and then I'm going to do that to you, you start worrying. But then there's a nice field experiment actually in Kenya, which is measuring cortisol levels across people when they receive. I think they receive some microcredit or some other program. I haven't seen the results from it yet, but I've heard that the results are again very similar, that you're going to get people under stress take bad decisions. So the advantage of doing it in the field is that they're getting real help with their stress, and when they get the real help with their risk, they actually take better decisions. So it's less artificial. But I think this fact is quite crucial in sort of understanding a lot of decision making among poor people, because they are under a huge amount of stress, and then we are expecting them to maximize utility over, you know, the rest of their lives and figure out which financial investment to make and you know, how to educate their children and all these decisions and get them all of them right. You might imagine that one of the things that happens when you're under a lot of stress is you get these decisions wrong. And if you get the decisions wrong, that obviously has long-term consequences for your life. So one other sense in which risk affects you is by making you take bad decisions. Yeah?
But isn't it often the case that for the poor, the options are in any case very limited? And for example, if a harvest fails, a lot of people will just move to other areas to do labor. And they also have few sources of credit, so if the crop fails, they will just go to these few people and take credit. So does decision making actually under stress actually figure very highly in decision?
I think the answer is yes. I mean, I think at the beginning of the semester, we looked at, you know, for example, just consumption decisions of the poor. You saw that what we saw there was that they were spending large amounts of money on things that they didn't need to buy. So that's a very simple example. Taking their child to be immunized. Should I take him today or take him in a month? And if I don't do it today, if I'm fully forward-looking, rational, I might decide, look, I might as well do it today because I'll never do it in the future. But if I'm subject to making bad decisions, I might easily make a decision on that. Which kind of, you know, should I spend the effort and the money to purify my water or not? I can miscalculate on that. Say, look, is the risk? I could think the risk is smaller than it is, for example. So I think that actually I would almost put it the other way around. I think we who live in, like, rich people have most of the decisions taken out of their hands. For example, you know, I don't have to take any savings decision. Mostly my savings decisions are taken by, you know, MIT, and then there's some plan which I'm supposed to join. I joined that plan when I joined MIT, and I've not changed anything. I don't have to plan my retirement. I don't really have to get to decide, you know, I don't have any risk mostly unless I do something really awful. I don't lose my job. I don't have to take many decisions on, like, you know, should I go look for a job there or there? I just come to my office and I'm done. I don't have the choice of not immunizing my children, because to the extent that I want them to go to school, the school basically enforces that. You can't get your children into school without immunizing them. Most decisions are actually of this class are taken out. I don't have to worry about water supply. I turn on the water, it's clean. I absolutely don't have to take the decision of whether should I purify this water before I give it to my son or not. It's a decision I don't have to take. Why? Because the water is infrastructurally cleansed before it reaches me. I get clean water, so it's not. I don't have to worry about that. I don't have to worry about whether or not my house can be made out of things which can catch fire, because before the house can be built, an inspector comes and checks it out, and I'm not allowed to build a house that can catch fire. So there's so many respects in which I don't have any choices given to me. Whereas if you're poor, you actually have 1,000 choices. I mean, I actually think that there are too many choices you have to make if you're poor. I mean, like, think of water. I mean, every day you have to decide, should I clean the water or not? That's a difficult choice to make on any given day. Yeah, someone else had yeah.
Yeah, so like how much of that though can you like attribute to, like, you know, bad decision making affected by cortisol, and how much of it is like because of like a basic misunderstanding of, like, you know, economics and utility and like future returns and stuff like that?
I think we don't know the answer to that. It's a very good question. One day we'll know the answer to that. This is all, like this whole cortisol stuff, we've only figured this out in the last 2 or 3 years. We're just beginning to get into these kinds of questions in a scientific way. Maybe in 15 years we'll know the answer to that question. Right now, this is one thing that I think is very, very, very recent, this understanding that this connection between cortisol and decision making, and then the fact that cortisols are related to risk. This whole thing is very recent, so I don't know the answer to it. It's a perfectly good question. I just don't know. Okay. No. So now, obviously, people don't take risks sitting down. I mean, they do something, they do stuff about it. So one thing you can do is you can borrow. You can go to and say that, look, I don't have any money today. I didn't, the truck didn't pick me up. Why don't you give me some money? And certainly people do that. We'll see that it's pretty limited and very expensive. So the alternative is to save. So you can borrow, you can save. We'll come to insurance later. But like, you can do most people, they do one of a fairly limited number of things. You can, if you save, now savings is a pretty good way to deal with. So imagine that you face a lot of risk and you can't borrow. Your decision rule, more or less, should be the following. You should consume the optimal decision rule. Whether people can figure this out, it took a Princeton economist and a computer to figure this one out. So maybe people can't figure it out. But let's say they can. Then the decision rule should be to consume everything when your income is low, everything you have. And then as soon as your income crosses a certain threshold, you should save the rest. And you should build up a stock for those days when things go wrong. Problem is that if you get 2 or 3 bad years in a row, this doesn't protect you at all. And so this is the next picture kind of shows that a little bit. So this is a simulation. This is nobody real. This is a simulation of what happens when you have income, consumption, and assets. Okay? So income is bouncing around. When income is high, you're accumulating assets. Then at some point, when income is low for a few years, your assets keep getting run down. At some point it hits 0. Then if you're lucky and income goes up right then you keep going up. Then your assets go up and you keep saving, you're fine. But sometimes you can see that, like in the middle, there is this place where income goes down sharply, and it goes down like there's some period on which several periods for which it's gone down. That sharp kind of knife, right in the middle. And you can see that what's happened there is your assets have hit 0. And because your assets have hit 0, there's no way you can just pull down your assets and protect your consumption. There's nothing you can do about it, and that's when you see consumption really dropping. So most of the time, you see consumption is a lot flatter than income. And that's what people find in the data. Consumption in general is very flat relative to income, but there are periods when it plunges. So if you get 2 or 3 bad shocks, then it really hurts. One bad shock you can deal with, but 2 or 3, and you run out of all assets, and then you suddenly your consumption drops massively. So you protect your consumption for a few periods, but then if your shock continues, then suddenly you get into starvation. So you get that picture is actually roughly what you find in the data. That people like, 2 or 3 years, at least 2 years in a row, maybe they just make it, their consumption doesn't fall. The third year, if the rain again falls, then they go into starvation. So that's a pattern that you see a lot, and that's exactly what you'd expect. People should try to protect their consumption till they can by running down assets, and expect that next time income will recover. But income doesn't recover after several times, then you get hit very badly. And that's sort of what we find also in the data. This is the pattern we also see in the data. Another thing you can do is try to work more. Problem, so one thing you can do, and everybody does that, when you can't you don't have, let's say when there's a drought and you can't, your farm, you go and start to sell labor. Problem is, when there's a drought, it's a drought for everybody else. Everybody's selling labor. What happens to wages? So wages keep going down. So in particular, it could very well be that in a drought, everybody ends up trying to work so much, and wages go down so much that amplifies rather than reduces the risk, because everybody tries to work. So I'm going to go and get work, assuming that everybody else is not working, but when I try to go to get to work, everybody else does as well. That drives down wages to the point where it could even be that it does nothing to protect me. I just end up working more and earning the same amount I would have earned otherwise. So this is something that, is this real? So there's a paper by Seema Jayachandran who basically looks at this, and what she does is she adds another wrinkle to it. So she says, well, how much you're going to go out and look for a job versus sort of save depends on whether you have a bank account or not. So if you have money in your bank account, you're less likely to go out and find an extra job, and more likely to live off your bank account, or at least partly live off your bank account. So you're going to be less desperate to find work. That's going to drive wages down less. So what she does is she looks at what happens to wages in drought years versus non-drought years, in areas which have good banking services versus areas which don't have good banking services. So this is data from India, and she's comparing areas which have good banking services versus areas that don't have such good banking services, and looking at the effect of that on wages in drought years versus non-drought years. So in drought years, wages are going to be lower. She's asking, are wages that much even lower in areas where the banking services are worse? Or alternately, are wages relatively less likely to fall in a drought year where banking services are better? Do you see the motivation for that? Okay, so that's the next table. So when crop yield goes up, which is basically rainfall, so this is always with district fixed effects. So we are comparing the same district over time, the wage in the same district over time, over this period 1956 to 87. Over these 31 years, we are comparing districts districts, the same district in a drought year and a non-drought year, and then we are looking for banking is something that improved over time. So in particular, if you look at the last column, banking is also something that's changing over time, and she's controlling for that. So, and then she's asking, is it the case that where the banking is better, the effect of a good yield in increasing wages is smaller? That's the same question as the effect of bad yield in decreasing wages is also going to be smaller. So it's going to be wages. The effect of yield on wages, is it smaller in districts which have is smaller in districts which have better banking services? And that negative in crop yield interacted with banking, that negative row in the middle says that yes, the effect of yield on wages is smaller where banking is better. As you'd expect, people are less desperate there. They can go to the bank instead of working, and therefore the fall in wages is smaller in those places. Now, we talked about saving, we talked about borrowing. There's a third thing you could do. We talked about saving, we talked about borrowing, we talked about working. There's a fourth thing you could do. Oops, that was dangerous. The fourth thing you could do is you could try to do things to avoid risk. Okay, so for example, what's an example of doing something to avoid risk?
Maybe diversify where you're investing.
Diversify where you're investing. Give me an example. That sounds right, but general principle. Give me an example of what do you mean by diversify.
Maybe, for example, if you're a farmer and have different types of crops, maybe so that some fail.
Right. So one example would be, imagine there's a high, if you could grow, there's two crops, sugarcane and wheat. Sugarcane is much more profitable, but wheat and sugarcane are subject to independent risk. So, when sugarcane dries up, that doesn't affect wheat, and when wheat dries up, that doesn't affect sugarcane. They're just different things affect them. Then by having a little bit of sugarcane, a little bit of wheat, you have less risk. But of course, you're paying in income. You're taking less income because sugarcane is more productive. So one thing people do is they diversify. In fact, there's like a very interesting paper from many years ago showing they diversify in many very complex ways. One thing that was very interesting is you'll find that in many countries actually, you find that the plots people crop are not adjacent. And that seems to make no sense. I mean, why would I farm over here for in the morning, walk 3 kilometers over there and farm in the afternoon? That doesn't seem to make any sense unless you think that there are some kind of microclimates. So it might rain here when it's not raining there, and it's maybe there is when a bug attacks here, it doesn't attack over there. So even when you're growing the same crop, you grow it over several plots, and the plots are not contiguous. You walk from plot to plot to avoid having exactly being in the same place, because if you're in the same place, then the same rainfall patterns or the same bugs you're subject to them. If you had multiple plots in different places, you can avoid that. Now that's of course wasteful because you are spending a lot of time walking, and you should have been spending that time farming. But at least you reduce risk. So the general principle is that you do many things to diversify. have many crops, many plots, many jobs. There's a study of how many professions a family can have. And I think the maximum number in that study was 27. They were doing 27 different things. Like, they were like small things, like, going to the pond and harvesting mussels for you do that in the morning. Then you go and collect firewood for sale. Then you go, your son goes and takes the cow to the field, and your daughter feeds the chicken. So you had to add up all those little things, but they were doing 27 different professions, I think was the number, if I remember right. But that's basically a sort of an extreme version of this, avoiding risk by doing a little bit of many things. The problem that's good, it allows you to avoid risk, but it's bad because you end up doing things which are not particularly productive. You don't do the sugarcane, even sugarcane is much more productive than wheat, so you lose money, and that keeps you poor. So it's estimated that if there's no weather risk, and so you didn't change your crop mix to deal with the risk, you would be 30% more, you would make 30% more money. So that's big, right? That's a big, basically the stuff that you're doing to protect against the risk is reducing your income by 30%. Another thing that it does is that because you're doing so many things, you don't get good at any one of them. I mean, one way to get good at a profession is by working very hard at it, learning the job. So a lot of these people, for example, they don't want to go to the city and become a full-time worker in the city. Why? Because they think they'll lose the job, and when they lose the job, if they still have the farm at home, they can come back to the farm and get a living from that. But if you that means that your job in the city is a temporary job. If I am hiring someone temporary, I have no incentive to give that person any skills. I know he's going to be gone in a month. So nobody gets taught any skills. Why? Because they're all temporary laborers. But why are they temporary laborers? Because they don't want to put all their money into this one basket, all the eggs into this one basket, because they think that if suppose I lose that job, what's going to happen? I might as well keep my foot in farming. And so they keep their foot in farming, they keep their foot in the city, they keep their foot in farming sugarcane, they keep their foot in farming wheat. So they do many different things. That means they don't get good at anything, and they don't take advantage of what they're good at. So one other thing you could do is actually offer insurance. The alternative would be to all of these strategies, and the logical alternative is insurance. What is insurance? What would be weather insurance? What's an insurance? What would a weather? Yeah.
I mean, the idea of insurance is to gather up a large group of people with different specific exposures to certain risks, and then to pool that risk. So you pay marginally in the event that something happens, and then you get a reimbursement.
What does the contract look like? I'm asking a simpler question. You're right.
You pay an annual premium, and then if something happens, you get reimbursed for it.
Right. So you say you pay, if the weather is really bad, you give me $1,000, and I pay $50 in a normal year or something. That's a yeah. You want to say something?
Another alternative to private insurance would be to have some form of government insurance. So I was thinking when you were talking about this that there were a lot of historically sort of much more, seemingly primitive societies who did a better job of sort of dealing with these issues, like say like the Incas or even like the Mycenaeans or something. And what seems to be different is that they had kind of somewhat strong functioning central states that redistributed across people. Like the Incas didn't even have money or sort of markets in the modern sense that we talked about yet. They had this sort of sophisticated system of redistribution and like collection of agricultural products to I guess, feed the military, but also to smooth risk.
Yeah, so we'll talk a little bit about that at the end, which is you're talking about, I think, something very important, which is what would public policy look like here? And you would want some way to insure people. But let's go. But I'm asking right now I'm asking a narrower question, which is, how would if there was a market, I was facing risk, and there was an insurance market, I could buy insurance, right? I could, if I'm worried about risk and I'm doing all kinds of inefficient things to avoid risk, I could get it. I could deal with it by just saying, look, you know, I'm going to buy insurance on the weather. When the weather's bad, I'm going to get money. So here's a weather insurance product in Ghana. This was offered at different prices to different people. The striking fact here is, so when you offer it at a price of 0, people are willing to take it. Not entirely surprisingly. However, if you offer them at a price of, as the price goes up, the actuarially fair price is, what is an actuarially fair price, if I can say the word correctly? Yeah.
The amount it actually costs, like in aggregate, to get to like an expected value of 0.
Right. So the amount I pay you in expectation is equal to the amount you pay. That's actually fair price. You can see that some people buy above the actually fair price. Why is that?
There are mismatches.
Sorry?
There are mismatches.
Because they're risk averse. So you may be willing to pay, the market, economic theory would say you should be willing to pay more than the actually fair price. Why? Because you know, actually fair price says on average you break even, but you know, but risk hurts you a lot, so you don't want to break even on average. You're willing to pay extra money to get rid of the bad things that happen when your money. So risk hurts you more than just you know. It's not just that, you know, sometimes you get more, sometimes you get less. The fact that sometimes you get less is worrying you, is making you do bad things that are inefficient. So you should be willing to pay more than the actually fair price to get insurance, because that's the whole idea of insurance. We typically, when car insurance is almost hugely not fair. If you look at the car insurance we have in the US, why do we have that? Because we want to be covered against the possibility that sometimes people will sue us for $1 million in damages. So and so we willing to pay a lot more than what's fair. So these people, they're not willing to pay at the fair price, 30% willing to take it and you have to really go down to about a price of 1 to get, that's 1/9 of the fair price to get people to take it. So people don't seem to want insurance. So if everything I said so far was true, why don't they want insurance? I mean, I said they did all the kind of these inefficient things to deal with risk. Isn't that immediately telling us that they should want insurance? Yes? No? Well, so, and in fact, when they take insurance, good things happen. So why don't they want? So this picture, what it shows is, this is the people who, this is spending on, total chemical spending is an odd title, but I didn't put it there, but it's total spending on chemical fertilizer. So how much fertilizer do you buy? Well, when you get insurance, you buy about, a little bit more than in control. So some people were offered insurance, some people were offered credit, some people were offered both. And you see there's some gains in investment. People underinvest when they get so relative to getting just the loan, insurance really helps. So when you get a loan, you don't want the loan if it doesn't come with insurance, because you worry that you can't repay with the loan. So you don't actually gain much. So if you offered a loan, you gain nothing. But when you offered loan and insurance, then your investment goes up by almost about 50%. So you really invest a lot more in fertilizer when you get insurance and credit together, relative to getting just credit. So that says that affects your income. This says that this affects your welfare. When you get insurance and credit, you are actually about half as likely to have somebody in your family miss a meal. That's an extreme form of risk. You're just starving because you don't have money. That halves when you offer insurance. So insurance is very good for these people. Why don't they want it? Insurance seems to be increasing output and reducing risk. Yeah.
I don't understand. So the both is if they get insurance
Both and credit.
loan. And so then the percentage of people missing meals, and that goes down dramatically.
Dramatically, yeah.
But why is it that if they have just insurance or just capital, it looks like it increases over the control?
It doesn't really increase. It's like, as you can see, it doesn't really.
Okay.
You need both. You need both for it to work. So why aren't they insured? And there are two versions of this question. One is, why aren't they buying insurance in the market? And the other is, why aren't they buying, if they don't buy insurance, they can still do something else, which is, one way to get insurance is for us, all of us, to just pool together. The government doesn't have to do anything, the market doesn't have to do anything. We all live in the same village. We can all get together, and we can all adopt the rule which says that if any of us loses 50% of their income, we'll all pay them 1% of our income. We could adopt that rule, right? And that would make everybody, would insure everybody, because there are like 50 of us in this room. We lose a little bit of, if I lose 50% of income, all of you give me 1% of your incomes, and I'm okay. So you can insure me. We don't need a market to do it. We can just do it at the community level. Yeah.
Isn't the significant limitation of that is the fact that you're not diversifying across like a larger geographical area, where presumably like a bad weather condition.
Absolutely, but we should at least do that. The fact is that people don't seem to have, seem to have limited insurance even from their friends.
But couldn't that potentially open you up to huge exposure as an individual?
Why?
In the sense that I guess if everybody gets hit equally, then even if you have a really bad year, but if everybody has a bad year, then you wouldn't require.
You can adopt a rule which basically says, let's take the average income of everybody, and then those who get more than average in that given year, give a little bit to the ones who get less than average. You can always do that. So in some sense, it's a puzzle. Why don't they buy it from the market? Why don't they buy it from each other? And there's been a lot of hype in this area, and people have been, like Forbes magazine had this issue where they said the insurance for the poor is an unpenetrated natural market. And a lot of microfinance institutions have been talking about the next microcredit revolution is microinsurance. So they're going to provide insurance to people. But in fact, we don't see very much insurance being supplied or demanded. Now, insurance is difficult for a variety of reasons. Does anybody know what moral hazard is?
Yeah, moral hazard is just the concept that, and I guess it can be best illustrated through an example. Like if there was huge concerns of a moral hazard about bailing out the banks because it could encourage banking institutions in the future to act more recklessly because there's this implicit guarantee of a backstop that happened once before.
Right. So one problem with insurance, but this doesn't explain why people don't want it. It just explains why it could be expensive, is that, if I offer insurance to you and I say that, I'll take care of you whenever your income falls, your incentive to stay home goes up a lot. That's moral hazard. What's adverse selection?
You're withdrawing those with the high risk.
Yeah. So the other worry is that you tend to draw in the people. So if I offer people the option of, I'm going to, whenever your income falls, I'll take care of you, I might only get the people whose income is already, they know their income is going to fall, come and join that scheme. That's adverse selection. So we have both of those. And then there's outright fraud, because people might claim their income has fallen, but in fact their income hasn't fallen. How do I measure that? So it's expensive to deliver. That's a given. But nevertheless, the reason why, so you might think that, but you would imagine that at least some forms of insurance should exist. One is catastrophic health insurance. Like you were in a traffic accident. Nobody gets into a traffic accident on purpose. Very little moral hazard. Why isn't there insurance for that at least? Another one is weather insurance. I don't control the weather. So, there's no moral hazard or adverse selection. I don't control the weather. The weather is what it is. So why don't I just, if you say that, why don't we get lots of markets for rainfall insurance? When the rain falls, when the rainfall is below some cutoff, I pay you money, otherwise you pay me money. So we would at least expect to see these kinds of insurance. It's difficult to have like more complex insurance. Maybe there's some fraud or something. But this kind of insurance, why don't we see more of it in the world? So I think, so this is a sort of where we're beginning to understand. So there was a huge hype. Like 5 years ago, everybody in the world was talking about how the next, there's going to be a revolution in microinsurance. And then the revolution kind of never happened. In fact, it was kind of, if you like, we work with a microfinance organization to offer insurance. And after about a year, they basically said, look, guys, we can't do this. We're losing clients every day. Because they were forcing their clients to buy insurance. The way you avoid adverse selection is by forcing people to buy it, right? You don't want to have people have choice. Otherwise, only the sick people will buy health insurance. They were forcing all their clients to buy health insurance. As a result, all their clients were deserting them. So they basically canceled the program. So nobody seems to want insurance. Now, it's really, I don't think people have fully understood what's going on there. I certainly don't. I mean, I think part of it is people don't understand insurance. So part of the problem is that people think, oh, I'm giving you money, and if I don't use this service, you should give me the money back. So, the idea that I'm giving you something, see, for most of us, the bizarre thing about insurance is a product that you really don't want to use, right? Insurance is one thing, but you want to buy it but not use it. I'm happy when I don't get sick, and therefore I'm really happy when I paid for it and I didn't get anything. But psychologically, it's an odd product in that sense. It's a product that you're happiest when you don't use it. So that's one problem, clearly. It's a bizarre product. It's one unique kind of product which, usually we're happy when we get what we paid for. Here's when you're happy when you don't get what you paid for. And that makes it difficult. Second thing, I think, is they don't trust the insurance company. And there's some evidence that when the insurance company comes through an NGO which people know and like, they're more willing to buy it. So there's some trust element there. But I think there's something else that I think is difficult. So think of catastrophic health insurance. I'm going to whenever you get really sick. So a theory is that this MFI was offering catastrophic health insurance. The theory was very simple. Nobody gets a heart attack on purpose. Nobody gets cancer on purpose. So let's just insure those things. That was okay. The theories seemed to work. Problem is, people also die from other things. Like they get they get some, their stomach hurts, and they probably got an infection and died. That's not covered by the insurance because, in general, it's only particular conditions that are covered. People don't understand why, one thing that is covered and another thing isn't. And if you explain that, well, there's more moral hazard in this one than that one, then that's too hard to explain. So basically, insurance products, out of the necessity of protecting the insurance organization from adverse selection and moral hazard, tend to be incomplete. They cover only a few conditions. People don't understand those conditions. So there was this big fight with this MFI we worked with. They got into this big fight with a group of women who were very upset because one of their friends' husband died. He died at home. He suddenly got sick and died. When he got sick, she went to the local doctor and brought, the doctor recommended a whole bunch of medication, expensive medication, which was useless because the doctor, I think, was bad. The insurance company said, this is not a covered condition. We can't pay for it because it was not covered. In fact, the insurance company in this particular case said, we'll only cover conditions that require hospitalization, and we'll only pay if you have been hospitalized. That's a very good way to check whether people are making up conditions or not. So they had imposed this hospitalization condition, which was to protect them. But then these people said, look, her husband died. How could it be worse? You have to pay. So there was a big fight. The insurance company refused to pay. As a result, all of them quit the MFI. So, just the nature of the product is difficult. I think there's one final psychological element which I think is also difficult, which is catastrophic insurance is particularly a product that makes you value it when you think about your own death or something really bad. People don't like thinking about those things. So it's very hard to get people to be rational about buying a product that involves contemplating really awful things happening to you. So a lot of people are both, I think, a little bit maybe they're a little bit superstitious about it. So they don't really like taking on this risk, thinking about these states of awful things happening. So if you're going to only insure awful things, like when the crop completely dries up, that's not what people want to think about. So that's another reason why. But in general, we don't fully understand why people aren't buying these products, but they aren't buying them. Okay, so if there's no question, I'll stop here. Even if